Well, thanks for tuning in to the Mutual Fund Show. It doesn't get any bigger than this, simply because it's the penultimate day to budget, and I'm sure all of you have in your minds what to do in a scenario like this, wherein the markets are looking slightly skittish. There is a lot of rumor about long-term capital gains tax and what could happen to the markets if it does come about. No one even knows what form and shape it will take, but there is fear on the street. Add to that the fact that the global markets haven't been really supportive. So to talk about all of this and more, and how should you as an investor be investing in, what should investor behavior typically be like, is a man who's seen many of these budgets and cycles. Needs no introduction. Mahesh Patil of Birla, Sunlife AMC joins us on the show. Mahesh, so good having you. Thanks so much for joining in, especially in the eve of an important event like this. What are you factoring in? I mean, is there fear on the street, or is there just some bit of apprehension about what this big event could do, and therefore people might just be taking a foot off the pedal?
Yeah, I think normally if you look at the budgets in the past, I mean, there is a lot of expectations, talk about it, but actually the budgets have now become actually a non-event from a market perspective. I think a lot of the changes happen outside the budget, even the tax slab and everything. Now GST has already been implemented, so all the taxation structure is pretty much well decided. In fact, increasingly after every budget now, the role what analysts is to do in terms of budget impact, that has been coming down. But there are some macro directions which the budget gives, which is important from a market perspective in terms of where is the focus going to be going forward, what are the areas where the big investments would be. And then, as you mentioned, some apprehension about capital gains tax, which is there at the back of the mind. But I don't think otherwise the budget should show any major surprises, which could change the course of the market.
What would you watch out for the most? I mean, the two obvious numbers and the big elephants in the room are the fiscal deficit number and the LTCG. But what are your thoughts on both of these?
So on the fiscal deficit, I think in the economic survey also, which came out, I think they hinted that there could be some room for fiscal accommodation. So we are expecting the fiscal deficit for next year should be around 3.2, not 3% what the government was targeting earlier. So some minor accommodation over there, which could be important because I think this year the government would want to spend a lot on a lot of the schemes, be in the rural sector or even trying to benefit the common man. So some amount of, but I think it would still be under control. We don't expect any large fiscal slippage. So one need not be too worried on that count, I would say. On the long-term capital gains tax, I think is anybody's guess. I think very difficult to really predict what will happen. I think if it is just an increase in the tenure from 1 year to 2 or 3 years, I think it won't be too bad from the market perspective, right? It will really, I mean, for equities, investors coming in from longer-term perspectives, it should not really affect the incremental flow which would come into the market.
But if it's not a definition change, but an actual tax being brought in, and we don't know the quantum really, so it's a bit of kite flying right now. But if that were to come in, would it derail this movement, or would it be a short-term blip?
See, again, I think it will be a short-term blip because if at all investors see that there is money to be made in the market and they can make decent returns, then, I mean, people don't mind paying tax, okay, if you're expected to make a gain. It's just whatever 10% or tax, okay, if at all it will come in. So I don't think it will really deter the flows as long as the outlook on the market remains positive. So if we are seeing, and what we believe that we are at a cusp where we are seeing a recovery in earnings, a recovery in the economy also, I think, after the last GDP numbers, and all the benefits which you have seen of the reforms, I think we'll see that gains unfolding in the next few quarters, the next few years. So if that is the kind of a direction which we are seeing for the economy and corporate earnings, then I don't think the outlook on the market really changes much. So except for a minor blip, because a lot of investors who would want to probably book gains, I don't see that would really alter the broader course of the market.
Okay, and I think Jayesh Khilnani has done some very interesting number crunching as to what typically happens to the markets pre-budget, on the day of the budget, maybe post-budget as well. So a lot of data analysis, and let's get him in to talk about what would happen to what has happened, really, let me put it that way, what has happened to the markets in the past few years. On the budget day, maybe post the budget day, maybe 1 month post the budget as well. And Jayesh, lots of data points. So you tell us, what have you chosen to show today?
So Niraj, in a nutshell, investors have always cheered the post-budget period. So what I did was look at some of the key indices, that is for the Nifty Bank, Nifty small cap and the mid cap index, and how they behave 7 days post the budget. Interesting analysis over here. So if you look at the Nifty bank and the Nifty index, so what you can see is that most of the periods they have actually given you positive return, except for 2012, where you had a marginal blip of about 0.7 to 0.9%. But if you look at the rest of the years or the rest of the budgets, you have seen healthy gains come about for the Nifty and the Nifty bank in the range of about 1 to 4%, except for Feb 2016, where we saw huge gains. Nifty gave you about 7% return in the 7 days post the budget, and Nifty bank about 10%. Now similar is the case with the mid cap and the small cap index. If you have a look, so once again, now in this starting Feb 2011, none of the years 7 days post the budget, the mid cap and the small cap index have given you negative returns. So we have returns ranging from about flat to about 2.5% 4%, and 2016 once again we saw the same case with Nifty and Bank Nifty, where the mid cap and small cap have given you about 6.5% to 9%. So this is, if this is to repeat itself, then the 7 days following tomorrow would be good for the markets.
Yeah, and I think I remember reading somewhere in I think a Morgan Stanley note or a Credit Suisse note, if I'm not wrong, that 10 out of the 14 instances, the 1 month return post the budget, actually the market performance 1 month post the budget has always been positive. Now it may be anecdotal, we don't know that, but there is certainly some merit to the numbers that we've and it's some story that numbers tend to say. Now Mahesh, there are two things to this, right? One is what the markets individually do for investors, one what it is to do for mutual fund investors as well. Let's first just argue it from an investor's perspective. And I can understand those 2016 numbers wherein there was a fear that long term may make a comeback. There was a bit of a sell-off, and then a result.
And the markets are correct because of globally also we had seen, coming from a lower base.
As well.
Yeah.
Now, today, this time around as well, while the run-up has been very, very swift, the last few days, and if you look at the broader end of the spectrum, there has certainly been a sharp pullback as well. If it is status quo, both on the fisc side as well as on the capital gains tax side, is it return to business as usual?
Yeah, I would guess so. I think because there has been some apprehension. We have seen some nervousness. We have seen some redemptions in the fund, people trying to preempt that.
Okay.
So if it is status quo, you will see money coming back into the market. I think to a larger extent, the market will be determined in the near term by what happens globally. We have seen some amount of concern even in the global front because of the bond yields. US bond yields have been rising. US bond yields have now crossed 2.7. And if they inch higher, there could be some volatility in the global markets. And that could really, affect our markets because we won't be kind of disconnected from what happens globally. I mean, up till now, we have seen in the last 1 year or so, very low volatility across globe and in India. I think you will probably see more volatility in this year. I mean, we have seen in the past. So I think investors need to, while the longer term direction for the markets remains fairly intact, and looks good, we are positive. But I think one should not be complacent. There could be correction, not just because of the budget. I think if budget is normal, things can come back. But because of global factors, one can expect some correction. But people have been talking about this for some time and we haven't seen that. But I think it happens when you least expect it, right?
Yeah.
So,
but drawdown should be bought into, you would reckon?
Oh, definitely, yes, definitely. Because I think the fundamentals are improving. I think if you sit back today and compare to even 1 year back, though last 1 year returns have been fantastic. But this year, it's looking more confident because we are seeing the benefits of all the reforms, what we saw last year. Big ticket reforms, whether it's in the banking sector, recapitalization, the GST, the housing sector push. So all these things will try to drive the earnings growth from here on. And I think overall liquidity also what we are seeing. I think investors are coming in for a longer term into the market. So that liquidity will also continue to pump in. And globally also, I think we've seen a good flow into emerging markets. The emerging markets have lacked the developed markets. So I think by that count, this year we should see fairly strong inflows even from the FIs coming in. So I think short blips or corrections will only provide an opportunity for investors to buy something at a more reasonable price than what it is today.
Okay, so the reason I asked this to you is because we've got a few queries and I want to bring up, Mahesh, this is typical investor behavior as well. I'm sure you experience a lot more this than we do, but a lot of viewers have sent in questions. I want to bring up one Twitter question in particular, I think from Ankur _ Jam or underscore JAM, and he is saying, and this is his question, that while Eurozone growth has reached the highest level, European markets are falling, Dow has had one of the biggest falls according to his analysis. Is it time when we should think about fund transfer from equity, maybe into other asset classes, maybe into debt mutual funds or otherwise? I'm guessing he's talking about this from a perspective of a mutual fund investor.
Sure.
What would you advise?
See, I think what we've been saying is that, equities have given good returns in the recent past, last 1 year returns. And the expectation of returns from here on in equity outlook is good, but has to be moderated down. So I think one can't expect the same kind of returns what we saw last year. If you're expecting, I think, realistic returns of around 12-13% over the next couple of years, and that's still a good return compared to any of the asset class post-tax which investor would look at. I would say that somebody who has invested early and has seen his equity allocation grow up significantly, it could be a time to rebalance the portfolio a bit, okay, and bring it back to the target equity allocation at this point in time, and spread across probably debt or other asset classes. I think that's one which one can do at this point in time. But many investors are still underinvested in equity, right?
Yeah.
So they need to actually continue to invest even at these levels, not worried about the current levels, or even if there is some correction which could be on the cards in the near term. It's very difficult to predict that and time that. And if you are entering in the market at regular intervals, many people have probably just entered into the SIP a year back, and they should not really think about stopping the SIP at this point in time, but continue doing that, because I think if you take a 2 to 3 year view, the markets can still be rewarding even from these levels.
Yeah, Mahesh, and not because you're here, but a couple of advisors in the last 1 month have come in and spoken about how investing into large cap funds might be a good idea. One of your fund features prominently in that list as well, Birla Frontline, if I'm not wrong.
Yeah.
I believe that house as a fund. Now, my question to you is, for somebody who has, over the last 2 or 3 years, on advice of advisors or otherwise, has investment in multi-cap funds, in small cap funds, is there a legitimate case for rebalancing some of that portfolio as well, either into balance or equity savings funds or into large cap funds?
So at this point in time, one would be slightly, our favor would be more for a large cap and a multi-cap fund. Okay, where larger allocation should be, and that's what traditionally we advise investors, that bulk of your investment should be in a large cap and a multi-cap diversified funds. Mid and small cap funds would, typically have an allocation of around 20-25%, not more. But over the last few years, you've seen a good rally in the small and mid-cap space, and that's where a lot of funds would have seen the mid and small cap allocation in their portfolios would have gone up. I think it would be good to do some kind of a rebalancing there, and rebalance this portfolio and allocate that towards a large cap or a multi-cap fund, and keep that mid-cap, small cap allocation around 20-25%, because for a longer term, I think mid and small caps will continue to do well, I think, but in the near term, the risk reward would clearly be tilted towards the large cap and the multi-cap funds. Obviously, other investors who are slightly more risk averse, balanced fund can also really fit the bill. We have seen large inflows coming into these hybrid category, be it balanced fund or the kind of asset allocation fund. And that's good for investors who are coming in first time into equities, which have a lot of money in debt. At these market levels, it would probably be prudent for them to look at a balanced fund if they don't want too much volatility in their portfolio.
Okay. Now, Mahesh, the last 10 odd minutes on the show, I want to focus on what do you think could happen on the big day tomorrow and what implications it could have for investors. Now, we've spoken about the two tax and fisc deficit aspect. Now, finer points within the budget. Almost everybody's saying that the budget should be written off because it's ceased to be as big an event as it used to be. No indirect taxes, so that goes out of the window as well. But there will be specifics introduced within the budget which could have an impact maybe on market sentiment, maybe on rural sentiment, so on and so forth as well, and investors could take those specific calls. So what do you expect would be the cornerstones of this budget? Would it be towards populism because it's an election year, or would it be on the lines of what PM Modi said in the interview, that public doesn't expect freebies and SOPs, they want development, and therefore that would be the agenda?
So I think it will be a tight balancing act, as usual it is for the finance minister, to really balance between whatever growth, what they need to do, and also keep overall fiscal deficit under control. So clearly, I think if you look at from the last budget, there has been a lot of focus on rural India, and looking at the elections, okay, which could be the next general elections are around the corner. I think we expect a lot of at least talk to boost farm incomes, okay, and also some expenditure on the rural side, whether it's in the irrigation or other projects. So I think clearly that is an area where you would see a lot of talk about. And also, not populist, I don't think there'll be freebies which will be there, but at least for the common man, especially the middle class is where I think the government could focus in terms of the tax slabs which are there. There could be some leeway given over there. And also to incentivize people, we would like to see that, to really incentivize people to save more. I mean, demonetization was a big move, where we saw a lot of money moving into financial assets and financial savings. I think if the budget is able to further give some impetus to that, I think that will be good for long term in terms of savings coming into financial assets and helping in for the development.
You would believe that would be what, via tax slabs being revised, or how would the FM likely to do that?
Yeah, I think the limits which are there currently, right, ATCs, I think those limits could be increased. Also for long-term retirement planning, okay, just like you have in US, okay, for 1Ks, I think if you would see similar incentives being given, I think those are the things which we would like to see that come into this budget. Yeah.
Okay. Any thoughts, Mahesh, on the universal basic income? Because the CA last eco survey floated this balloon, invited comments on it, but did mention that unless the tax GDP ratio really goes up meaningfully, there should not be any tinkering. But it is the pre-election year, and this could be as favorable a pitch, and it's probably a good move for a rich country, yes. But it is a pre-election year. You think something like that could be tinkered with, or too difficult to guess?
You're talking about the
universal basic income.
Yeah, I don't think. I think they'll tinker with that. I think overall tax, I think revenues, what the government is looking at, we should see buoyancy. I think more importantly is how the GST collections, and just think if they get more traction over there and see a buoyancy over there, then I think they could look at some of these things.
Okay.
Right. Otherwise, I don't think they'll want to tinker at that in this budget.
Okay.
Yeah.
I read within your views that you believe that a scheme like Parantha, which is working in Madhya Pradesh, if I'm not wrong, could be in the realms of possibility at national-wide level. Why do you think this could come about, and what would it mean? I mean, does it have any relation to an investor's perspective that maybe rural income could go up and therefore those kind of sectors could do well, etc., etc.?
Yeah, I think as I mentioned earlier, I think, trying to really get the farm incomes, that's what the government has mentioned in the policy. They want to double farm incomes over the next 5 years. And there are various ways they are looking at. I think the Parantha scheme, which was introduced in Madhya Pradesh, has seen a good traction, okay, where you try to protect the farm prices, right? The MSP prices which are given through the MSP mechanism is also available in the open market, where you reimburse for those costs. I think those kind of things, looking at the traction, what it has got over here, could be looked at and implemented nationwide. And that should help really relieve some of the stress on the rural side. And I think some of these things, if they really click up, then you could see the overall rural consumption, which has been kind of slow and got affected in the last 2 years. We see that to really come back fairly strongly. And it will also help the government also in terms of trying to get back some of the confidence from rural India, which, I mean, still all said and done, 60% of the population is there in rural India. And that's what the government will look at when they are looking at for the next elections.
Okay, last question on the budget. Year one, he had spoken about a corporate tax cut. It's still not come in. Do you think the budget has the fiscal space to bring about a corporate tax cut?
So I think it will be a bit difficult looking at where things stand at this point in time. And I think that's where I think the finance minister would have to take a bold step in terms of trying to say, okay, the whatever reforms which have been done on the taxation side, be it GST and demonetization. What we have seen is that the first level in terms of trying to increase the penetration of number of taxpayers, both in indirect as well as direct taxes, has gone up. I think the compliance level has to now go up. And with e-way bill coming in, I think the finance minister would have to look at more buoyancy in the tax revenues and overall tax to GDP ratio going up next year. I think if he does that assumption in this budget, I think then he would definitely have room to really at least make a beginning towards reducing the corporate tax rate, which he had promised earlier.
Safe assumption to make, you think?
Yeah, I think so. I think he has mentioned that a couple of times. So I think he should make a beginning, at least a small beginning.
Yeah, but what I mean is, do you think it's a safe assumption to make that tax or corporate revenues would go up? I mean, is this earnings season giving you signs of that?
No, it's not only the earnings season. I think one is the direct taxes. What I'm saying is the compliance level, right?
Okay, fine.
So with GST coming in, I mean, the economic survey suggests that there has been a 50% increase in the number of filers, right, for GST. Now, just because filing tax returns, you can still show that there are zero tax to be paid, right? So it's as the compliance increases, as there are avenues to evade taxes are plugged, and the e-way bill, which is getting introduced now, again, it's concurrent with the budget. That should help to see a buoyancy over there. And we are pretty optimistic that the GST revenues should gain traction, and that should help the finance minister really play around in the budget if he has revenue buoyancy coming in.
Yeah, certainly. I mean, I think the CEA spoke to us yesterday as well, and the talk was that maybe just not for this budget, but for subsequent budgets as well. Just the number of assessees moving up by itself
that should be
a big thing.
Yes.
Okay, last couple of questions, Mahesh, and that is non-budget, but purely from an earnings perspective or otherwise, is this buoyancy in earnings, at least seeming buoyancy in earnings, heartening, or was this expected, or do you think Q3 has been better than what you anticipated?
So I think it's slightly, we were expecting revenues to recover from Q3 onwards because the last year base has been very favorable. And we have seen the post-GST, the normalization has happened much faster than what we had expected. So to that extent, growth was expected, but what we have seen is that almost 3/4 of the companies have actually reported neutral or better earnings, or surprise on the earnings, which I think is a bit of a surprise, I would say, or positive, a pleasant surprise, I would say. And if that trend continues, then I think it should be good. And next year, we are expecting the growth to be around 20% for FY19. I think that should be clearly possible because we are seeing a lot of sectors starting to do well. I mean, earlier it was a few sectors which were doing well, but now it's getting broad-based across sectors which were kind of underperforming or not doing well, like, for example, the banking sector or the pharma sector or the IT sector. I think we are seeing signs of improvement over there.
Okay. And I have one final question that has come to me, Mahesh, which is what, and it's specifically addressed to you because I had mentioned that I'll be asking a question to Mahesh Patil if you tweet me that question. So I've gotten a question which says, I've gotten a question which says that please ask Mahesh Patil that the last 12 months I've heard the term TINA quite a number of times, which speaks about how because there is no alternative, people should come out and invest in equity markets also because equity markets are giving good returns. Now with equity markets returns likely to moderate a bit from what the earlier levels were, are there alternatives available?
So I think market, there are always alternatives at any point in time, right, to invest into other asset classes. And investors should continue to really not put all eggs in one basket. We never say that, put all eggs in one basket.
Okay.
And all asset classes are cyclical. We've seen that, right? We've seen market cycles in every asset class. So I think I don't believe there is no alternative. Okay, at every level, you need to have a balance in your portfolio. There are at times when certain asset classes look very attractive, okay, where you need to have a higher allocation. I think equities still continue to remain attractive from a longer term perspective, but that doesn't mean that one should ignore other asset classes, be it debt or be it real estate or gold. Okay, one needs to build that and build a portfolio which is well diversified depending on one's risk appetite.
This is an equities manager saying this.
Yeah, I think it's always prudent to do that, right? Yeah, though I would say the tilt at this point in time should be towards equities because that still looks to be, at least for us, to be a better asset class over the next 2 to 3 years time frame.
Well, now you know the man means his advice because here is one of the largest equity fund managers telling you that even the equities still should be there, but you should also have your hands in some of the other asset classes. Mahesh Patil, sound advice and always great having you. As I said, more so today, the penultimate day to budget when the markets have just started to turn a bit nervous. Thanks so much for joining in today.
Thank you.
And viewers, thanks for joining in and tuning in to the Mutual Fund Show.